It starts by getting back in the game. Now, here's what I'm guessing is your situation. You had a bout of financial trauma. There was something happened. It was a medical issue. It was a job loss. It was a divorce. It was something like that. And since that time, after you've gone through this credit trauma, you've kind of avoided credit since then. I mean, it's painful to go back and apply for credit and either be turned down without ceremony or just, that whole process is tough. So this is what happened. This is how you get back in the game. Credit scoring is only about 10 years old. I don't know if you knew that. And we used to score manually. If you were a mortgage lender or an auto lender, we did not feel we had to have scores. I mean, we did it manually. We scored everyone manually, either A, B, C, or D. D was denied. If a borrower did not pay us, we took the collateral back, whether it was a home or an auto or a washing machine or whatever it was a collateralized loan. And after we came up with our evaluation, we lent them the money. If they didn't pay, we just went and took the stuff back. So it wasn't a big deal to us. The credit card companies, though, they could not do the way that we did because, first off, they're unsecured creditors. And they needed a way to make fast decisions because of the number of people who were applying for cards. And, everybody was applying for multiple cards. They didn't want to do the scoring manually because it was taking them too slow and they were making bad decisions. So they wanted a way to tell the good payers from the bad payers. That's where the scoring mechanism came up with. Now, what you're looking at now is a chart, and it is heavily slanted towards credit cards. Now, let me explain this a little bit. It makes sense to me that 35% of your credit score is based on your payment history. That makes all the sense in the world. Now, the amounts owed, this is kind of an interesting thing. Amounts owed, it really should say the amounts owed against the limits of your credit cards. It's not really the amounts owed against your mortgage. It's not against how much the car you owned. It's the amounts owed against the limits on your credit cards. And then they also talk about the smaller parts of the length of your credit history. Of course, the longer the file, the better. New credit, they worry about this. And then the types of credit used. And that's a whole different subject. But this is where we're going to focus on right here. Credit card research shows this is what when they were trying to figure out how to make the algorithms work for scoring, this is what they did. They did a research project and they found that before people go into bankruptcy, they charge up their credit cards to the max. Now, I will be the first to tell you that I do not believe that the people that were charging up their credit cards were doing that in an effort to get back at the credit card companies. I honestly believe that they were doing that trying to hold off the bankruptcy or to avoid it completely. And in many cases, they might have got through. In a lot of cases, they didn't. So again, we're back to this. And this is why this algorithm is in effect, is because they want to know how much you owe versus how much your limit is. So here's a result. If you have a revolving credit card and your balance is more than half of your limit, your score will go down. If your balance is less than 30% of the limit, your scores will go up. Now, here's an example. The balance on this credit card is $3,000. The limit is $5,000. They've got a 60% ratio of their balance to their limit. That will cause the scores to go down. Now, on these other ones, they're okay. This is 25%. They owe $1,000 against a $4,000 limit. And so, all in all, this person's credit score would probably be pretty good. It would go up if they paid down this particular one down to about $1,500. Okay, so hopefully that makes real clear sense for you. So here's the deal. You need a credit card, but your credit sucks because the stuff that's been on your credit, the stuff that since you avoided credit, the only thing that's showing up on there is the negative credit. So you need a credit card. I mean, that's a key thing, and you need one that reports to all three reporting agencies. You also need to get one that you can be approved by. And it may be smart to even have more than one. So here's the big tip, all right? This is the helpful tip. You need to get a secured credit card. A secure card is offered by many financial institutions, usually credit unions and smaller regional banks. A secure card is secured with your funds that are deposited into a new savings account, your savings account, But the credit card is against that. The credit card is collateralized by the money that you put in the savings account. So you're basically borrowing against your own money. This takes all the risk away from the bank, and that's the reason that they're able to do that. Plus, they charge interest, and of course, they charge fees on those. So they get their share, but it is a big way to help you get back into the game and have a revolving credit card. That's very important. There's a couple rules here. You are only going to use this card for small purchases. I tell most of the people, just buy gas with it or just buy meals out. The balance must stay below that 30% of the limit. So let's just say that you put in $500 into the savings account. You get a credit card where the limit is $500 because that's what your savings account balance is. Then you don't want to spend more than about $150 on this card any month. Okay? When the bill comes in, I want you to pay it immediately. Now, I do want you to leave a small balance. Leave a $5, $10, $15, $20 balance on there, because it seems like if you pay it down to zero and the reporting time frame comes in and it says zero, it doesn't help you as much. So keep a small balance on there. Very important. So how long will it take to affect your scores? Well, it could happen very fast. I suggest you give it 60 days because of the cycles of the way credit cards work, and you have to pay them. They want to see a good payment history. They want to see the balance. But if you're within 15 to 30 points from qualifying, you're going to be very pleased if you follow these instructions precisely. So let me summarize this for you. If you have not had any late payments in the last 12 months, if you do not have any judgments or owe the IRS, if you do not owe delinquent student loans or child support, you may be within a couple months of buying the home of your choice at market-based interest rates. Now, this is, I'm telling you, the rent-to-own and the seller financing, some of those deals are good, most are not. This is the way that you should do it, and most likely you're closer than you believe. Okay? Now, this is what I want you to do. If you want to find out if you qualify, I want you to call me at 281-348-9899. Here's my email. Or you can go to my website. You can find me there. And I also want you to watch this video, another video that explains how the credit scores work, and it talks about the balance versus the limit and all that kind of stuff. And that video is going to be at the bottom of this one. So hopefully this was helpful. Hopefully you understand. Obviously, if you don't, I want you to call me. So this is Mike Durr signing out. Thanks a lot. Bye-bye.